Hello investors, and welcome to my YouTube channel where I study the best investors and businesses from around the world. In this week's video, we'll go over Guy Spier's investing career and the 9 rules of investing which he has created. This video will be covered in 3 parts. Part number 1, who is Guy Spier? Part number 2, Guy's investing life. Part number 3, Guy Spier and his 9 rules. So let's get straight into it. Part number 1, who is Guy Spier? Billionaire investor and Warren Buffett protege Guy Spier is a graduate of the Harvard Business School and Oxford University. He came to Wall Street in the late 1980s and soon converted to the Benjamin Graham style of value investing. Spier is the founder and managing partner of the Aquamarine Fund, a Buffett-style long-term investment manager. Guy was born in February of 1966 in Pietermaritzburg, South Africa. Although his mother is German, his father is an Israeli, and when he was just 3 months old, the family moved to Tel Aviv, Israel. In 1970, just after he had finished kindergarten, Guy's family moved to Tehran, Iran, and he attended the British Embassy School. Just 7 years later, the family again moved, this time to Richmond, England. Before college, Spier finished out school at the City of London Freeman School in Ashted, Surrey. Spier began his college education in 1984 at Brasenose College, Oxford University. There he studied law and was tutored by Hugh Collins and Mary Stokes. In 1986, Spier switched majors in order to study PPE, politics, philosophy, and economics. He studied with many influential people, including Peter Sinclair, David Cameron, and Vernon Bogdaner. During this time in his life, Spier also interned with the Creditsanstalt in London and completed courses at both Ruprecht Karl University and Harvard Summer School. At Harvard, Spier was offered places in both the Joint Business and Economics PhD program and in the MBA program. He decided on the MBA and completed it by 1993, just 3 years after the offer was given to him. While working as an associate at Braxton Associates from 1988 to 1990, Spier got started in an internship at the Forward Studies Unit at the European Commission in Brussels. While attending Harvard Business School, Spier said that he interviewed with firms like Goldman Sachs and JP Morgan, but chose to work for D.H. Blair, a much lesser-known company, instead. Spier became the vice president of the company, but said it was a Wolf of Wall Street type experience, and that he regrets the decision to go with the smaller company. However, learning early on that many companies were only in the category of might succeed helped Spier to be even smarter at the companies that he chose to invest in later in life. Once he decided to leave investment banking, along with Mohnish Pabrai, Spier funded the Aquamarine Fund. The fund is an investment partnership very similar to Warren Buffett's investment partnerships in the 1950s. The goal of the fund is to use compound interest to build financial security and wealth for its partners. It's not a get-rich-quick kind of scam, but rather a very smart, simple, long-term investment fund. Mohnish Pabrai, born in Bombay, India, is one of the many people that Guy holds to a very high standard. In 1991, Pabrai took a huge risk, taking about $30,000 out of his 401k and taking on $70,000 of credit card debt in order to start his own IT consulting and systems integration company, which he named Transtech Incorporated. 9 years later, he was able to sell the company for $20 million to Kurt Salmon Associates. In 1999, Pabrai funded the Pabrai Investment Funds, which he still manages today. In 2005, the Pabrai family opened the Dakshana Foundation, which literally means Infinite Good Foundation. The goal is to push their wealth back into society, believing that it's more needed there than in their own pockets. They give about 2% of their wealth, which is about $1 million every single year. The donation most often goes to alleviate poverty in India, providing tutoring services and enabling some children to attend a few of India's elite institutions of higher learning. Like Spier, Pabrai has a high regard for the famed investor Warren Buffett. He's even admitted that his investing style is copied from Buffett, along with others. Pabrai is also an author and has written multiple books such as The Hondo Investor, Low Risk, High Value Method to High Returns, and Mosaic, Perspective on Investing. Both of these books are very similar to Guy's book, The Education of a Value Investor. Spier and his fellow value investor Mohnish Pabrai said they fulfilled a lifelong dream, which they bid more than $650,000 in 2007 in a charity auction for a lunch with Warren Buffett. Spier continues to manage the Aquamarine Fund, and now it has about 150 investors and over $350 million in assets. Today, Guy has his own website, podcast, and newsletter, and is still running the Aquamarine Fund. Recently, he also started a YouTube channel called Guy Spier. Spier's website, guyspier.com, is where he shares his favorite investing research platforms, social media, people to learn from, knowledge management platforms, books, and even just his thoughts on specific topics. His website has links to all his social media, his podcasts, and his other businesses, Aquamarine, ValueX, etc. You can find Guy Spier's podcast on Apple Podcasts, Simplecast, and Spotify. The podcast is called The Education of a Value Investor, and as of March 2022, it has 31 episodes, most of which are interviews with other money experts or highly educated people. Guy's newsletter, Stay in Touch with Guy Spier, is accessible through his website, social media, and other resources. It's really more of an email subscription list, but nonetheless, it's accumulated several thousand subscribers. Spier says that he uses the letter every once in a while to share something that he's found significant or important, but that these emails are sent no more than 5 or 6 times a year. The channel is now up to 1.42 thousand subscribers. On his channel, Spier interviews a wide variety of people. He has met with authors, executives, film critics, brand builders, doctors, and even a baroness. Part number 2, Guy's investing life. But going back to Spier's investing, why did he choose the Benjamin Graham-style value investing? In order to get why Spier chose this investing method, we need to understand what the method is. The original value investing philosophy was created in the 1930s by a man named Benjamin Graham. Graham was a British-American investor, economist, and author. He published a book, Security Analysis, with co-author David Dodd, as well as his more famous book, The Intelligent Investor. He even taught Warren Buffett at the time that he was in school at Columbia University. In fact, Buffett has said that Benjamin's teachings, as well as his books, have become the bedrock upon which all of his investment and business decisions have been built. Graham specifically stressed the separation of the two types of investors, short-term and long-term. Short-term investors are those who try to time the market to make a quick, large return on their investment, whereas long-term investors, or value investors, consistently buy into a company, not caring about short-term fluctuations or what the market thinks about what the company is worth. Benjamin Graham even went so far as to create a formula to find the intrinsic value, which is the value of assets after it has grown. In other words, the underlying value of a stock. This equation is V equals EPS times 8.5 plus 2G, where V equals intrinsic value, EPS is the 12-month EPS of a company, 8.5 is the PE ratio of a zero-growth stock, and G is the long-term growth rate of the company. In 1974, the risk-free rate of 4.4% and the current yield on AAA corporate bonds were both added to the formula. The Benjamin method is fairly simple to use, and for most investors, has become the best option to discover the best and worst investments. Guy Spier has been using the Benjamin Graham method of investing since the beginning of his own investing career, and it has obviously worked out very well for him. Over the past few decades, Guy and his company have accumulated over $350 million in assets. In the last couple of years, Guy has also expanded his passive income network. He not only has a large investment portfolio, but his little side businesses like selling his book, running a podcast, writing a newsletter, and running a YouTube channel also act as passive income side hustles for Spier. Guy has been very successful as an investor and as CEO of the Aquamarine Fund, but his side hustles have also provided the world with a lot of insight into the investing world. In September of 2014, Guy published his book, The Education of a Value Investor, My Transformative Quest for Wealth, Wisdom, and Enlightenment. In the first line of the book, Guy states that his goal in writing the book was to share some of what he'd learned on his path as an investor. He says that his life was changed by his mentors, including and especially Warren Buffett, and that he hopes his book could have a similar effect on some of his readers. In his book, Guy Spier goes over his investment experience in great detail. Later, he condensed chapters 10 and 11 of the book into the 9 investing rules, which he follows, thoughtfully designed to make self-discipline easy and block out all of the excessive noise from the Wall Street guessing game. Part number 3, Guy Spier and his 9 rules. Guy's first rule is to not check stock prices so often. A lot of investors check their stock prices way too much. They have a constant nagging fear that if they stop paying close attention, something bad will happen to their investment. But being able to always see the stock price is not a good thing. Seeing the constant fluctuations in the stock price will almost always give an investor either false reassurance that everything is going to be great, or excessive fear that could cause them to pull out when the stock price dips. When value investing, it's best to periodically put more money into the stock and simply let it go up over time. The best stocks for value investors are usually index funds, which don't go up very quickly. In fact, over a period of around a year or two, these stocks may have actually seen a decrease, but over a long period of time, they're almost guaranteed to go up an average of about 7 to 8% each year. Spier admits that if you're speculating on a biotech or internet stock, it makes some sense to follow the price movements more closely, maybe even daily, as things can change really fast. Otherwise, he suggests trying to invest in a more measured way, buying stakes in companies that you can hold for years, if not indefinitely. Spier believes so strongly in this that he suggests you establish a system where you only check stock prices once a quarter, or maybe even once a year. He says that even as a fund manager, he checks the price of his holdings no more than once a week. The second rule is that if someone is selling you something, don't buy it. Spier points out that the human brain is likely to make irrational decisions when dealing with a well-argued pitch from a gifted salesperson. You don't want to be caught with a bad investment that at first you thought would be amazing. Spier suggests no exception, no sales policy when it comes to an investment. He says, I adopted a simple rule that has proved extraordinarily beneficial. When people call to pitch me anything at all, I reply in as pleasant a manner as possible, I'm sorry, but I have a rule that I don't allow myself to buy anything that's being sold to me. This rule is protection against any impulse buying, which is buying something because you want it at the moment. It is always best to do your research and maybe even wait a couple of days before buying to make sure that it's not an emotional decision which you might end up regretting later. To go along with the second rule, Guy's third rule is to avoid speaking to management. Although it sounds pretty backwards, Spier says that he avoids speaking with the management of the companies that he's researching. It goes back to rule number 2, as he argues, the trouble is, senior managers, particularly CEOs, tend to be skilled salespeople. No matter how their business is performing, they have a gift for making the listener feel optimistic about the company's prospects. Knowing my own rational limitations, I'd prefer not to expose myself to this potentially distorting influence. Company management is almost always very biased towards their own product, and rather than helping you with whatever you needed to speak to them about, they will more than likely just try to sell you their stock or product. Rule number 4 is to do your investment research in the right order. Guy Spier says the best place to start your investment research is by looking at the firm's public filings, especially the annual report, 10K, 10Q, and proxy statement. He points out that you'll need more than just these documents, but they do provide a lot of valuable, reliable information on how the company is performing and will continue to perform. This is especially true for the US-based companies. It's also very important to carefully read the accountant's audit letter. This is because a lot of times the audit can hint at potential problems within the company. Next, do a thorough review of corporate filings after all of this. Spier says that he then starts to look over less objective corporate documents, such as earning announcements, press releases, and transcripts of conference calls. These will give you an even more in-depth understanding of the company before you buy into it. You'll want to know the business inside and out before you decide to risk your portfolio in it. The 5th rule is to avoid discussing your investment ideas with biased people. According to Spier, bouncing your investment ideas off others is important, but you need to be careful who you share it with. Some investors are just in the market to make a quick buck. They might try to create a meme stock by getting a bunch of people to buy into a really small company and launch its value to way more than it's worth. Maybe they're trying to help, not wanting you to miss out on a good stock, but just didn't do their research. Or maybe they try to get you to buy into their own company because they just need more investors. So they become salespeople trying to get you to buy their stock, saying it'll go to the moon if you invest. You can really only trust your own research and your own institution when it comes to something as important as investing. Spier suggests that you should avoid oversharing and instead pool your knowledge with other investors while sticking with those people who can keep their ego in check. Rule number 6 is to not buy or sell stocks during market hours. Now, this seems pretty weird, right? But Spier, inspired by his partner Mohnish Pabrai, stands by the rule of not trading stocks during regular market hours. You don't want to get wrapped up in trying to wait for the best price during the day just to miss it. Timing the market rarely works, and when it does, it's luck, not skill, that leads to success in buying the dip. Spier says that under most circumstances, the best plan is to call up your broker the day before you want to buy or sell stock and request to trade the stock at an average price for the upcoming day. The logic is that this is much easier, and although you might not end up with the lowest price of the day, you also won't end up with the highest. This rule also goes along with rule number 1, which is to not check stock prices too often, as it keeps you from consistently watching the stock price throughout the day. Rule number 7 is to not sell after a big drop. Spier rightly points out that selling a stock that has taken a big hit is emotionally fraught. That just means that it is an experience that really toys with your emotions. This is kind of like an impulse buy, but it has become more of an impulse sell type of situation. To deal with the really strong emotions, Spier follows another Pabrai-inspired rule. If he buys a stock and it goes down big, he will not sell it for at least 2 years. The argument is that this rule acts as a circuit breaker, a way to slow down and improve the odds of making rational decisions. If he's already lost money, Spier figures might as well not worry about losing more. After all, there is still a chance that the stock will go back up, and he will earn his money back and possibly even more. Spier's 8th rule is to avoid talking about your current investments. Experience is the best teacher, and Spier has learned that it's a bad idea to speak publicly about stocks which he owns. He says once we've made a public statement, it's psychologically difficult to back away from what we've said, even if we've come to regret that opinion. If you've told people you own stock or that you'll never sell it, or really anything, it's really hard to do anything but what you've already told people. You would feel really dumb selling a stock you said you would never sell, or even buying into a stock that you previously criticized. The 9th and final rule says that you must develop your own investing checklist. Guy Spier insists that most, if not all, investors have a written checklist to stop them from making repeated mistakes. In fact, he spends an entire chapter of his book simply developing the idea of a personal investing checklist. This checklist would be different for everyone, as we all have different budgets, different opinions, and different experiences. Describing his version of a checklist, Spier says, a checklist is not a shopping list of the desirable attributes that we're looking for in a business. It's a list of predictable errors. My checklist includes items like, is a top executive going through a tough time personally that might cloud his or her judgment? Is there a key part of the company's value chain that's vulnerable? Is the stock cheap, not just based on what I think will happen in the future, but on where it is trading today? A list of all the investing mistakes that you have made in the past is a good starting point. Then, every time you consider buying or selling a stock, carefully review your list to be sure that you're not going to make the same mistakes again. Then, every time you consider buying or selling stock, carefully review your list to be sure that you're not going to make the same mistake again. Spier's rules were created through his personal experience, and they probably won't work perfectly for everyone. But the rules are a great starting place, as they are amazingly simple and very effective in creating a healthy, less risky portfolio. By implementing each of these rules into your investing portfolio, you should save yourself from a lot of mistakes and hopefully make a lot more money too. Thank you for watching this video entirely to the end. Nothing helps me out more than y'all sticking it out until the end. Please consider subscribing to this channel if you haven't already done so. Also, if you enjoyed this video, please like this video and subscribe to my channel so that I can continue to make videos like this for you to enjoy.